Hey everyone, welcome back to Corporate Decoder, the place where we take a deep dive into corporate filings and uncover the real story. Now today we're looking at Elevation Series Trust, specifically their Form N. CSR, a certified shareholder report. This kind of report gives us a peek into how a fund is performing and what its holdings are. And let me tell you, this one has some interesting details about a fund called the SOV. Rain's Capital Flourish Fund, so buckle up because things got a little bumpy this past year. Before we dive in, if you enjoy getting straight to the point insights from these dense financial documents, do us a favor and hit that subscribe button. And while you're at it, join our Discord community if you appreciate honest financial analysis without the jargon. Linked in the description below. Alright, so we're re-looking at the Sovereign S Capital Flourish Fund for the period of the 1st of August 2024 to the 31st of July 2025, and right off the bat they tell us it had an annual shareholder report. But we're re-skipping the pleasantries and getting straight into the numbers, because that is where the real story is. So how did this Flourish Fund actually perform over the last year? The report says its net asset value declined 3.88%. That might not sound like much, but it significantly underperformed its benchmark, the S&P 1500 Equal Weight Index, by a whopping 502 basis points. That means for every $100 invested, the fund lost almost $4. While the index gained over $1, the report explains this poor performance was due to tough earnings season and some companies missing their targets. This was especially true because of things like tariffs, healthcare, and immigration reform, and shifts in consumer behavior in the wake of artificial intelligence. The Fund S manager noted that for companies within the fund, consensus analyst earnings forecasts for 2025 were reduced by about 7%, much worse than the roughly 2% reduction for the broader S&P 1500. Now they express disappointment with this relative performance, especially in the last 4 months of the reporting period. But they also believe their long-term process of picking companies with strong cultures, led by faith-driven CEOs, will eventually lead to better results. They also highlighted their impact initiatives, talking about CEO Roundtable, that have led to programs like chaplaincy and employee benevolence funds, which they believe have positively impacted hundreds of thousands of employees. Let's look at the actual performance versus the benchmark in a real-world scenario. Imagine you invested $10,000 at the fund's inception back in September 2023. By July 2024, you would have had about $12,394, which was actually slightly better than the S&P 1500 Equal Weight Index at that point. However, fast forward to July 2025, and that same $10,000 investment was worth only $11,900. $12, that is a significant drop from the previous year, a decline of almost 4%, while the benchmark S&P 1500 had grown to $12,480. Digging into the fund statistics, we see total net assets at $114,430,900 with 76 portfolio holdings. The portfolio turnover rate was 40%, which means they bought and sold 40% of the portfolio. Over the year, that is a moderate pace. Looking at the average annual total returns is stark. The Sovereign S Capital Flourish Fund had a minus 3.88% return over 1 year. This is a notable underperformance compared to its benchmark, the S&P Composite 1500 Equal Weight Total Return Index, which had a positive return of 1.14% for the same period. Since inception, however, the fund shows a 9.99% return, while the benchmark sits at 12.81%, indicating it has consistently lagged its benchmark. Now let's see what this fund actually invested in. The top industry sector by far was software and tech services at 17.51%, followed by healthcare at 10.92% and industrial services at 10.75%. This means a significant portion of the fund is exposed to the tech and services sectors. Geographically, the fund is heavily concentrated in the United States, making up a massive 97.70% of its investments. Canada and the United Kingdom represent very small portions at 0.56% and 1.74% respectively. Alright, let us get into the nitty-gritty of their actual holdings. This is where we see the specific companies the fund has put its money into. We're looking at the schedule of investments as of the 31st of July 2025, and this is the most detailed part of the filing. In the healthcare sector, which represents 10.92% of the portfolio, we see holdings like Molina Healthcare, incorporated at over $2.8 million and US Physical Therapy, incorporated at over $2.2 million. Digging into the largest sector software and tech services at 17.52%, we find companies like Fiserv, incorporated with a value over $3.1 million, and Euronet Worldwide, incorporated, also valued at over $3.1 million. And there is also Repay Holdings Corporation Class A at over $2.5 million. These are significant investments within this already large sector. Within tech, hardware, and semiconductors, representing 8.91% of the portfolio notable holdings, include NetApp Incorporated, valued at over $3 million, Cisco Systems, incorporated at over $2.2 million, and Supermicro Computer, incorporated at over $1.7 million. There is also a small allocation of 0.30% to money market funds, specifically the Invesco Government and Agency Portfolio Institutional Class, valued at over $343,000. This is typically used for stable cash holdings. Now let's look at the statement of operations. This tells us how the fund made and lost money during the year. Investment income from dividends was $125,8573. However, expenses were also quite high at $673,866, mainly from investment advisory fees. This left a net investment income of $584,707. The big story here is the investment performance. Net realized loss on investments was substantial at nearly $6.2 million. However, there was a large inflow from investments sold in. Totaling over $9.3 million, this netted out to a positive total net realized gain of over $3 million. On the flip side, the net change in unrealized depreciation on investments was a significant loss of nearly $7.9 million. This means that while the fund was able to sell some positions profitably, the overall value of its remaining holdings depreciated. Altogether, this resulted in a net decrease in net assets resulting from operations of over $4.2 million. For the year, this is a negative number, meaning the fund lost value. Looking at the statements of changes in net assets, we see the story continues. The net decrease in net assets resulting from operations was a negative $4.2 million. This was partially offset by shareholder transactions, where the fund saw a net increase of over $60 million derived from share transactions. This means more money came into the fund through the sale of shares than was paid out through redemptions, leading to an overall increase in net assets from about $58.5 million to $14.4 million. Let us dive into the financial highlights for the most recent year, the net asset value. Per share started at $30.93 and ended at $29.64, a decrease of $1.29. This aligns with the overall negative performance we be seeing. The total return for the year was a negative 3.88%, which is pretty dismal, especially when you compare it to the 23.94% total return in the previous period. The ratio of net operating expenses to average net assets was 0.75%. This number remained consistent from the prior year, indicating the cost of running the fund stayed the same relative to its size. Now we turn to the notes to financial statements. These often contain crucial details. So what is going on here? The fund was organized on the 7th of March 2022 as an open-end management investment company. Its investment objective is long-term capital appreciation, and it focuses on companies led by faith-driven CEOs. This is a pretty unique angle, but it also means the investment universe is smaller and perhaps more susceptible to specific market trends. The NAV is determined daily, and the fund uses fair value procedures when market quotations are not readily available. This is standard practice, but it relies heavily on management's judgment. Looking at the fair value hierarchy, we see that all of the fund's investments in securities, common stocks, and money market funds are categorized as level 1. This means they are valued using unadjusted quoted prices in active markets. This is good. It implies the vast majority of their holdings are liquid and their values are easily determined. The advisory fees note tells us the fund pays a unitary management fee of 0.75% of average daily net assets. This fee covers substantially all of the fund's expenses except for a few specific items. Vidant Asset Management serves as the sub-advisor, and they are compensated by the advisor out of this management fee. This structure, while common, is important to understand because it shows how money flows within the fund. Management structure. In the tax basis distribution section, we see that for the year ended the 31st of July 2025, the fund had $273,101 in ordinary income distributions. This is important for shareholders when they do their taxes. The net unrealized depreciation on investments for tax purposes was over $2.8 million, which is a notable number. Finally, we have the report of independent registered public accounting firm. They state that the financial statements present fairly in all material respects, and they audited the fund since 2023. This provides a level of assurance on the accuracy of the numbers presented. So let S wrap this up. The sovereign S Capital Flourish Fund had a rough year in terms of relative performance. While it aims for long-term capital appreciation and focuses on a unique niche of faith, driven companies, its recent results show a significant underperformance against its benchmark. The heavy concentration in software tech and healthcare sectors, coupled with a near total investment in US companies, certainly put it in a position to feel the pinch of the specific market headwinds mentioned in the report. The good news is that despite the one-year stumble, the fund has attracted a lot of new money, which suggests investors still have confidence or are drawn to its unique investment philosophy. However, the strategy of investing in companies led by faith, driven CEOs, while Noble Dozen Tea seem to have insulated it from broader market declines this past year. The key risk here is whether this distinct investment strategy can truly deliver long-term outperformance, and if the current market environment will continue to challenge it. The large unrealized depreciation also points to potential future losses if these positions are sold. Looking ahead, it will be crucial to watch if the fund can regain its footing and if its unique approach can translate into market, beating returns, or if it remains a niche product that struggles when broader market forces are unfavorable. Alright, that is our deep dive into the sovereign S Capital Flourish Fund S latest filing. What is your take on these numbers and what they signal for the company? S Future, drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the corporate world. Don't forget to check out the Discord community in the description below. Thanks for watching, and I'll see you next time on Corporate Decoder.